Yeah, hi, good morning, everyone. Thank you for taking the time out to join us today. We're back with another Decipher with Deserve session. So, what we typically do here is run you through the happenings in the markets, different sort of products, what this means for your portfolios, and just general rumblings in the economy and markets. So, I'll introduce myself quickly. My name is Kushal. I work in the investment team at Dezerv. We're joined here today by Pratik Bagaria, who's the principal officer at Dezerv. All of the investment decisions and legwork and brain work that happens behind the scenes in regards to our investments and in turn your portfolios runs through Pratik. So today we have an update for you on what's happened behind the scenes in the corporate earnings, what's happened for our economy, and what this ultimately means for your portfolio. Um, Pratik, would you like to add something?
Thanks, Kushal, for the introduction and great day to be doing this. Yesterday evening itself, the GDP numbers are out, and here we are talking about earnings growth. So, a great topic to discuss, very timely, and I hope we have a good discussion today with our audience as well. So, good morning, all of you. Welcome to the webinar Decipher. We can maybe just start with the conversation now.
Yeah. So so as you alluded to earlier, we've had a positive surprise on the GDP front.
Yeah.
We've also heard about the RBI's estimates of 7.7 to 7.8, but it's been a big positive surprise. Your thoughts on this, what the key drivers were, and maybe what's in store for the future?
Yeah. So not just RBI, in fact, almost every other analyst or economist on the street was expecting the GDP growth to slow sequentially. So last quarter it was 7.8. This quarter people were expecting that it will be between 7 to 7.5. Nobody was expecting that it will surpass the last quarter. But that is exactly what has happened. 7 to 7.5, 7.75 at best was the range. We are at 8.2. What contributed to the GDP? If we look at uh, from the consumer side, it was the private consumption that really helped. The government spending actually it slowed down a bit, but despite of that, the private consumption helped the GDP go up, which is a big positive, right? Because we are primarily a um, consumption-driven economy, and for that engine to kick and keep firing, that's important for us. The investments part also, that also has after consumption, that's the second contributor. So because of larger investments, we have uh, the GDP rate higher. If we look at in terms of the segments of the economy, for example, agriculture, manufacturing, services, there we see that manufacturing has contributed the most. So for manufacturing, which was growing at 7.6% in the last quarter, sorry, 7.7%, that has jumped up to 9.1% this quarter. So that big bump up is there in the manufacturing, and that has been one of the major contributors, which is again a positive for a developing economy like ours that manufacturing picks up, which will lead to more growth and employment. It's very necessary that so good numbers backed by the good reasons.
Got it. So, I mean, these numbers, what goes on behind the scenes? What are a few of the key drivers? Now, coming to the sales of the corporates, could you maybe walk us through what's happened here? Maybe tell us why there was a slowdown and what has led to this sudden uptick?
Yeah, so just looking at the numbers first. So last quarter we were growing our sales. This is the universe of Nifty 500, right? So that accounts for almost 90% of the revenue that Indian companies make, right? So that was growing at 5% till last quarter. This I'm talking year on year. Um, i- in Q2 FY26, the growth has moved up from 5% to 8%. So 5% was one of the slowest quarters, but now with 8%, we are in one of our fastest quarters in a long time. So last you can see on the chart Q1 FY25. So that will be basically your uh, uh, June 24 quarter. So June 2024, we were seeing growth of 9%, and it was on the decline. But after that, it's almost what 1.5 years we are seeing, uh, 1 year, 1 quarter, we are seeing 8% growth after that, and it's picking up now. So yeah, that's a great positive. And GDP is for the economy, it's good for policy making, etc. But from an investment perspective, how GDP is translating into sales and profits, that is what matters to us. And GDP is the biggest driver of the sales and profit. As long as the GDP keeps on growing, people consume, we will have good sales growth in the markets, and stock prices keep rising.
Right. Thanks. So while we saw that uptick in sales, is the story similar on the bottom line, the profits? Are we seeing a similar trend? And what is driving this? Maybe the key industries, some that are not contributing?
Yeah, so in a quarter, Kushal, India Inc. makes around 4 lakh crores of profit, right? This is in the previous quarter, which is quarter two, the quarter ended September 25, we made 3.9 lakh crores of profit. Right? That's a huge number, and that is just one quarter. So in 4 quarters, roughly we will be at around 16 lakh crores of profits. Uh, this is 15% higher than where we were in Q2 FY25. We were at 3.4 lakh crores. Now we are at 3.9 lakhs. So it's a good 50,000 crores addition to the profits. Right? It's as big as some of the policy announcements that come in. So uh, growth pace has picked up. Definitely, that's a great positive. The base of the growth also, one should appreciate that it's not a small thing, right? To grow on that kind of a base, it's not a small economy, not a small country or a market where we are growing on a small base. On a base as large as $3.5 trillion, we grew by 3.5 trillion rupees. We grew by half a trillion rupees. What we can talk about, Kushal, is next is that how is the quality of this growth? Whether, okay, we have seen a good quarter, but
Mhm.
does that mean that going forward, we will be able to see, uh, we should expect this momentum to continue?
So when you say quality of growth, I'm assuming you are alluding to a broader base of contributors and
Yes,
not just a few
yes,
heavyweights. Got
sure.
it. So, could you maybe walk us through what you were referring to, where that uh, uptick is coming from? Maybe some reasons why there's a few laggards as well.
Yeah. So basically, if you divide the EPS growth into various segments, right? There will be loss-making companies, which is around 4%. 2% plus another 2% which have turned from profit to loss. So all the loss-making companies put together is 4%. Hmm. So sorry. That means 96% of the companies in Nifty 500 are delivering profits, right? That leaves you with like 480 companies are making profit, and 20 companies are in loss. It's a great base to have of profit-making companies for any growing economy and a market like India. Then you take other segments and keep raising the bar. So let's say around 18% of our companies uh, saw profit, but the profit growth was not there, right? So around 30% of the companies did not witness a profit growth. They were making profit. Uh, so leaving this 34% aside, 65% of the companies are not just making profit, but they are growing their profits as well. So again, we are not in the market. You can't say that we have saturated and we are not growing. 65% of your companies are growing. That means you are pretty much in a growth market. Now, the last 65% segment also, if you divide, you break it up into two, the company which are growing between 0 to 15% and companies which are growing above 15%. There are 20% companies growing between 0 to 15%, which is a lukewarm growth rate. But almost half of our market, which is 46 to 47%, 46.5%, that market is growing at a rate more than 15%. That is much above our nominal GDP growth rate. So our real GDP growth rate came at 8.2. If you add half a percent inflation to that, the nominal GDP growth should be around 8.7%. So it is growing nearly twice that pace, half of the market. And then that's a great news. Leaves fund managers and equity investors with a lot of room to pick up stocks which have growth potential.
Got it. So, I mean, again, in conjunction to what you said earlier, we
Yeah.
have a snapshot here of where that growth has come from. We
Okay.
can see
Yeah.
that there's a wide array of industries that are contributing. Maybe you
Yeah.
could hammer down on what the big ones were, why we've seen such a sudden uptick, and maybe a few of those red bars towards the end, if there's some cause for concern there.
Sure. So half a trillion rupees, as is here we have mentioned it in millions. So 500 million is the growth in profit, right? We spoke about it. We grew from 3.5 trillion rupees to 4 trillion rupees. So where is this extra half a trillion rupees coming from? Out of that 500 million extra, the 500 billion extra that we are getting, 200 billion rupees is coming from oil and gas sector. So that was the biggest contributor to the uptick in the earnings growth this time. Then you have NBFCs, which are doing really well, majorly because of gold loans doing well. So just to give you an idea, gold loans went up from around 1.5 lakh uh, crores to 3 lakh crores in just 1 year. That is 100% growth. And gold has not doubled. Gold has gone up 70%. Gold loans have gone up 100%. So some of the NBFCs, reflecting in their stock prices also, they have made a good growth number there. And remember, they are at a much smaller base compared to oil and gas, metals, cement, some of these heavy infra companies. Uh, so yeah, you have your usual names, telecom, insurance, healthcare, etc., which have also reported and contributed to the growth. Coming to the ones which have uh, uh, shown some negative contribution to the growth, primarily is okay. Media is a very small contributor, and the negative contribution is also very less. Right? They have eroded $1 billion from the growth, but private banks, they've eroded around $13 billion from the growth number. Uh, and autos. There you have a 3.32 billion rupees of erosion in growth.
Got it. So,
So
so I mean, any concerns here? You're seeing this slight erosion, although it's slight, there is an erosion. Are there certain triggers or maybe green shoots that are giving you comfort where you'll see that this will pick up in the
so
future?
initially there were concerns around credit offtake, right? So on this chart actually, if you see for around 6 to 7 quarters, the growth rate for credit has consistently gone down. In Q2 FY24, 2 years back, we were at 20% credit growth. It fell to 17, 13, 11.2, 11, then 9.5 in the previous quarter, June quarter. And now, for the first time after such a long period, it has shown the first uptick at 10.4%. So, this is one sign where your credit growth, you could see so that coming back. NPAs obviously is low. That is partly priced in as well, but a low NPA coupled with growth can be a good positive for banks. So, while we are seeing them not really contributing towards growth right now, but going forward, that picture you can expect to change. Even for autos, uh, on Diwali, I'm sure that a lot of people on this call would have bought a car or a bike, uh, because the numbers clearly show that, right? There has been a 50% jump in two-wheeler sales in just uh, if I compare month on month. So October 2024, we sold around uh, 2 million motorcycles or two-wheelers. And in October 2025, we have sold 3 million. That is 10 lakh more two-wheelers sold in the month of October. So that is one big area for and when auto companies do well, obviously the supply chain, which is your auto ancillaries, the people like tire manufacturers, battery manufacturers, those guys also benefit from because it's an entire supply chain. It's not one provider which is benefiting from that. Even for passenger vehicles, if you notice here on the slide, the growth is 24%, which is a huge jump. And primarily, this can be attributed to the GST relaxation that the government gave, announced on 15th August, implemented on 22nd September. So, October was the first month where we actually saw these things flowing through. So,
Got
autos also, while negative contributor this quarter, should improve going forward, and both of them should add more growth to the overall Nifty 500 index level growth.
Understood. So, I mean, we can see that 8.2% GDP growth fueled by all of these urban consumption, a broad-based growth in earnings across sectors. Certain laggards like your private banks and autos, we're also seeing a healthy uptick
Yeah,
in credit growth. You're seeing the GST cuts have now translated to higher auto sales. But
right. At the
another
same time,
key,
just
yeah.
one more thing. While the GST cuts have translated into higher sales, the GST collection has not gone down. People were expecting that the fiscal deficit will increase because the government will not be able to meet the revenue targets, but that is not happening. We have the early GST numbers in the month of October, and that's clearly not the case. Sorry, Kushal, you were saying.
Yeah, so I mean, all of this points to a healthy urban participation.
Yeah,
But I mean, I'm sure there's another component to the GDP in a form of the rural side. Can
yeah.
you maybe walk us through what's happening there? Have they contributed? If not, do we see signs of contribution in the future?
So yeah, manufacturing and services make a large part of the economy, and so does agriculture. How agriculture contributes to the, if it does contribute into production, but the income generated from there then gets spent into your FMCG products, your buying into bikes or cars, those things. The basically the demand driven by the rural part of India. There you have seen this year, in fact, last 5 years, we've had good monsoon, and that's something very rare in India that you hear 5 consecutive years of good monsoon. This year also, we are at 1,254 millimeters of rainfall, and we haven't completed the year. So, in this data should be as per end of October. We'll have 2 more months of rainfall getting added. So pretty comfortable, similar to 21, 22 uh, calendar year levels. 23, 24, we had lesser rainfall, not very less, but slightly higher rainfall this year. Now, that is translating into this your winter crop, which is Rabi. The sowing is increased. So last year in 24, the acreage there was 27 million acres of land was used to sow rabi crops. This year that has gone up almost 10% to 30.6, 31 you can say. So 31 million acres extra, 3 3 to 4 million acres of land extra being used to sow rabi crops. Obviously that will uh, result into extra income for the rural population, um, extra consumption, extra demand. So that's always a good sign. We are still not at the same 2023, 22, 21 levels, uh, but it's definitely an uptick, unlike the slide that we were experiencing over the last 2, 3 years.
Right. So, just for the benefit of our viewers, if you could tell us all of these strong upticks and good signs here, how do they translate to industries, and where will we see this uptick in terms of sales, earnings, maybe certain economic numbers that will uplift the markets?
So specifically this one, Kushal, there are four segments of the economy, right? You have manufacturing, services, rural, and you have construction. Out of that, agriculture is a large enough component for us even now. So that leads to more production. If your rainfall is good, you will have more production of crops. That leads to more income. If there is income in rural, there will be more spending, and that indirectly translates into better earnings growth for FMCG companies and auto companies, things like those, or even for banks and NBFCs. The previous ones that we spoke about, the autos and the credit growth, those are more direct. So auto sales numbers going up directly impacts an Eicher Motors or a Mahindra and Mahindra. Credit numbers growing up, uh, credit growth picking up, that directly impacts your banks and NBFCs, right? And then finally, at an aggregate level, those numbers add up to the index contribution or the India Inc.'s profit pool.
Got it. Thanks for that. So, I mean, with all of this buoyant activity and great signs ahead, how is this affecting our portfolio construction, the asset mix in terms of industries, maybe market capitalization, and ultimately, how should a client structure their portfolio or view it in from a broader lens?
So from what we discussed, Kushal, I think one very, very big key takeaway is that we are in a very different year compared to 2024. 2024, we were approaching a bottom like this. And in 2024, we formed a base, and now the fundamentals have started picking up. Every number that you look at, whether it be GDP, this rainfall, Rabi acreage, credit growth, auto numbers, whatever we looked at today, everything points towards a better 2025, obviously reflecting in the numbers also, right? Now, that uh, means we have better growth ahead of us. At the same time, markets have remained stagnant, right? So it gives you a great opportunity to enter the market at this level. So if we can just look at the valuations, um, we will see that yeah, thanks. So in quarter one FY25, the first line, right? Uh, Nifty 500. We are not talking about Nifty 50. This is Nifty 500. Nifty 500 was at 22,560. Where was it at the end of quarter two FY26? Basically September. Again, we were at 22,734, which is just like 174 points higher
Right.
than that quarter. But at the same time, EPS, what has that done? That has grown from 839 to 928, right? That has gone up 90 rupees. Now, EPS going um, up much faster because the base is just 800. Here, the base is 22,000. So EPS has grown much faster. That means the PE has come down. When your price is not growing as fast as EPS, what happens? The PE comes down, which we can see here, right? The EPS in quarter one 25 was 26.9. Now we have come down to 24.5. That is a good 10% lower than where we were. So let's say even if we were to go back to 26.9, the markets would have to rise by around 10% to go there. But if we add one more dimension to that, which we spoke about today, is that growth. Just look at where we were in terms of growth in FY25. We were growing at 4%. So a market growing at 4%, you were paying the market was paying 26.9 times earnings to that market. Now we are growing at 15% and the market is giving it a lower PE. So if you look at this ratio called PEG ratio, which famously Peter Lynch has given us, we were at 6.73 and that ratio has come down to 1.63. That shows that the markets are very attractively priced if you factor uh, uh, the fact that the growth is now back. So let's say if this 1.63 has to even go back to 2 or 2.5, that will be a very meaningful upside for the markets.
Got it. So, I mean, for a lay person, could you just break down how this PEG ratio translates to price movements in the index? What sort of interlink it has with earnings and ultimately the indicator that almost everyone looks at, which is the PE ratio?
Yeah, so PEG ratio is nothing but your PE divided by growth. So, for example, if you pick any of these numbers here, 26.9, I'm picking the first one. That was the PE, and 4% was the growth. So, if we divide 26.9 by 4, we get 6.73. That's your PEG ratio. Currently, we are at 24.5. Earnings is at 15%. And if we divide 24.5 by 15, we get 1.63. Simple arithmetic. Right now, if let's say the growth were to stay here, even if we stay at 15% growth, the next year the EPS would increase by uh, 15%, right? So to keep up at 24.5 PE, the markets will have to increase 15%. So markets will have to grow by that much. But in case we are revising our PE, then markets will have to grow that 15% plus whatever revision it comes in form of PE re-rating. And PE re-rating is clearly a possibility, right? Because we are not at a PE which is like one standard, two standard deviations above. We are pretty much at long-term averages.
Got it. Thanks, Pratik. Also, if you could maybe summarize, so we've seen a big GDP number come out recently, great signs across the industry in terms of earnings growth, sales growth.
Yeah.
There's a lot of green shoots in the industries that have not yet shown that healthy earnings growth. Valuations look to have normalized after a sustained period of the index, rather the Nifty 500 going nowhere. How do you see this playing out in terms of broader portfolio construction, maybe in terms of where you see the index headed from here, and how should an investor approach this in terms of deployment?
So in terms of equity markets, Kushal, clearly the sign is that we are headed higher because there are two times in equities, right? One is when the markets are looking cheap, and one time when the markets are looking good. This is that one of those few times where the market is looking good and at the same time cheap, right? In COVID, the market was very cheap, but you really had doubts whether the growth will come because you were seeing negative growth surprises and those things, right? But this time you have the growth backing you. You have the valuations in your favor. 1 year of consolidation going nowhere. So it's clearly a time to buy. You should have a positive outlook on the market and uh, declutter yourself from thoughts about uh, other asset classes of too much. Equity should be your mainstay. Yes, you should diversify a bit with debt. Some allocation towards precious metals like gold, silver could be helpful, but don't make them the mainstay of your portfolio. Equity has to be where the money should go this year at least, going forward 12 months.
Right. So, thanks, Pratik. That was very insightful. We'll look to address a few questions that have been asked.
Sure.
Some of the viewers would like to know what the long-term impact on the economy would be due to certain government expenditure and what appear to be freebies. Direct tax collection has improved, but how do all of these factors interplay with that and impact it?
So, fortunately, unfortunately, freebies have always been a part of Indian government's finances. Uh, Earlier, it was done in form of oil subsidies, but etc. The other kind of subsidies, the long list we had. Now, the good thing is that while we have cut down subsidies, we've managed to cut down subsidies. That's a good thing. The not so good thing is that we still have to dole out some sort of freebies in terms of handing out to people. Uh, but that is still positive, right? Because it goes to the consumer directly, helps in consumption somewhat. Not the best way to go about it, but uh, you can say that we have made one step of progress. It might take more steps to support the, let's say, the lower end of our population. At the same time, make sure that growth is not compromised. Um So yeah, that's where we stand on the freebies.
Got it. Thanks. So we have a few questions also on global factors like your
It's
crude oil.
sorry, Kushal. Just coming back on that, what is reassuring to look at is that on the government, even after doing these things, our government finances, at least the central government finances, are not looking in a bad shape, and that is where we should focus on. So as long as it's not going out of hand and you are creating fiscal deficit for these things, uh, we are home.
Right. So we have a few questions surrounding certain global factors like crude oil prices and of course the most more talked about AI bubble or lack thereof in the US. How do you see this playing with our stellar financials? Do you see a spillover effect? Are we well insulated or do you see some sort of effect happening here?
See, my theory is that AI, in terms of our market, did more bad to us than good, right? Because we hardly have any pure play AI companies in India. Whatever money that was chasing AI that moved out of India either to China or to US or Taiwan, semiconductor companies, companies making chips, LLM models, those, right? And it didn't come to us because at best we would have found some clean energy companies and data centers. That's the linkage to AI for Indian companies. So the valuation of AI, if that is becoming a concern, it should only be a positive for India because, and that's purely my view, right? That if your foreign investors have pulled out money because of that, and that trade is reversing, it should be a positive for India.
Understood. In terms of precious metals, we've seen a stellar rally in both gold and silver over the last year. What signs point to right now are equities being fairly valued, maybe positioned to be more attractive. Your thoughts on that and how one should approach allocation towards these precious metals, or should one choose equity or a good blend of both?
You are the right one to answer this one, Kushal. You've done enough number of times. How many grams does a Nifty cost now? Maybe you should take this one.
Absolutely. So, I mean, we've done a few research studies on how many grams of gold it takes to buy 1 unit of various marquee indices across India, be it your Nifty 50, Nifty 500, your mid and small indices. So, what we're currently seeing is that the amount of grams of gold required to buy an index is more than two standard deviations below its long-term averages. So, long story short, what this implies is that currently, in terms of relative valuation, equities look far better placed than your gold or silver. However, a caveat here, in terms of your long-term strategic goals, we still would like to see a certain amount of gold and silver in the portfolio. Is that correct, Pratik?
Yeah, 10% allocation to gold as a diversification. In case there are shocks or any unforeseen events which are difficult to predict, right? That is when you have some allocation in gold, which can be or any uncorrelated asset like debt or liquid cash. That will be helpful. If you blend that with your portfolio, it will give you a much smoother ride compared to investing outright in equity. But equity should be the mainstay.
Got it. So we also have a few questions on foreign institutional investors, how we've seen a consistent outflow over the last fiscal year.
Yeah,
While we are all aware that we've seen a robust response in terms of domestic flows,
yeah.
do you see any concerns regarding this outflow and maybe if there would be certain impact on a few industries?
So it's a known thing, right? And as long it's a known negative, negative does not matter. Known unknown is what scares and spooks the market. As long it is known, it gets priced into the market. So market knows that last 2 years, 3 years, or maybe longer, we've seen FII outflows. Uh, we've known that there is a lot of supply coming in form of IPOs. We know that there is a lot of promoters who have sold stakes and got out. Regardless of that, domestic institutional investors have absorbed all of this, and they are still scratching their head where to invest the remaining of the funds with them in cash, right? So flows clearly has been handled very well by domestic institutional investors, and with mutual funds uh, adoption picking up, it is very difficult that this flow will abate, because we have never seen SIP numbers going down significantly. In a year, they might come down by, let's say, a few percentage points, but we've never seen, the graph has only gone up. So currently, we are close to around 30,000 crores of SIP per month. Is that right, Kushal? Around that
Yeah,
number, right?
yeah, around that number. Yeah.
So that is the kind of supply. So 30,000 multiplied by 12, you have like 3 lakh 60,000 crores every year to absorb your IPO and the FI selling pressures.
Got it.
Just in fact, you should think the other way. What if this turns into a positive? Because that is a unknown factor.
Got it. And in terms of our inflation numbers, we've seen record lows. We're currently at 0.25% year on year in terms of our CPI.
Yeah.
We've touched upon multiple times how the GDP growth rate has been a huge positive surprise. How do you see this? Like, what does traditional wisdom tell you in terms of rate cuts? Are they still on the cards? Do we see that playing out the way we saw it would play out maybe a month ago?
So two or three factors that will be affecting rate cuts, right? How fast and how much is the Fed cutting the rates? How is the inflation scenario in India, and what is the growth rate? So while the growth rate is comfortable, we would obviously like to grow faster. That it's never enough there. But inflation gives you a lot of room for rate cuts, and the possibility that Fed will cut rate, again, that builds a positive case for India that rates will go down further. In fact, even if we don't want to guess, the RBI governor himself has said that there is scope for rate cut. It just a matter of time. Whenever the panel decides, we should see some rate cuts.
Super. In we have some questions. We spoke a lot about the GST cuts, how that has translated to stellar growth numbers, especially this last month for
Yeah,
autos.
yeah.
Traditionally, when something like this happens, what are the second order effects? How is that passed? How do we look at it from a portfolio lens? Like, does that affect our decision making in any substantial way?
So in our case, in Dezerv case, we are doing a fund of fund structure, right? So the security selection bit, as in which stocks to buy, how much allocation to give to the sectors, that is thankfully handled automatically at the fund level, fund manager level. What we are basically controlling is how much of mid cap, small cap, large cap allocation to have. What sort of style allocation fund managers do you want? Whether you want value oriented fund managers, you want growth, you want a mix of both. Um, so from that point of view, what changes is that you want to go more towards uh, growth oriented style now, and you want to go more aggressive towards, let's say, mid caps or the smaller companies. And last year our stance was to stick with large cap, and that played out beautifully. Um, but now we would focus more on smaller companies delivering higher growth, or fund managers buying such companies. That will be from our portfolio standpoint.
Got it. So from what I take from what you're saying is that going forward, it's going to be more of certain pockets of stocks that would be delivering alpha and not a broad-based rally as we've seen over the last few years. Is that the right takeaway?
That is also true. Yes, correct.
Got it. Understood. I mean, this was great, Pratik. Very insightful. Any closing thoughts that you'd like to pass on? Few words of wisdom.
No words of wisdom. The biggest advice right now would be is don't miss out on equity. Uh, Pour your heart out. Obviously, do not leverage, do not overeat, as Rakesh Junjunwala would say. But this is the time to get into equities. There are few times, as I said, where you get a clear highway about you. You are confident about the valuations. You are confident about the growth falling in. Uh, it's difficult to find growth at a reasonable price while everybody is claiming to do that. And this is one of such times. It should not be missed.
Super, super. Thanks, Pratik. That was really helpful. Viewers, I hope this was insightful and a enjoyable session. Thank you for joining us here at Decipher at Deserve. We hope to bring you a lot more of such content over the next few weeks. Thank you very much for joining us and hope you have a great weekend ahead.
Yeah, I would also request you to leave your feedback about these sessions, both text and whatever you can, so that we can structure these sessions better going forward.
Thank you.
Thanks
Thank
so
you.
much. Bye.
Yeah, thank you, everyone.